Welcome to the Value Investing online course by myvaluepicks.com. We have designed this course based on successful investment strategies from value investors like Benjamin Graham, Warren Buffett, Charlie Munger, Peter Lynch, and Howard Marks. We have studied legendary investors such as Benjamin Graham, Warren Buffett, Charlie Munger, Peter Lynch, Howard Marks, and Joel Greenblatt. What was the secret to their success? After 10,000 hours of research, we came up with a simple blueprint. Buy good quality companies at a reasonable price. Buy low-cost index funds at a reasonable market valuation. At a minimum, try to stay away from low-quality companies. You will be able to learn how to pick stocks like Warren Buffett and how to think about market prices. You will also learn how to avoid big mistakes. Our passion is to find high-quality companies available at reasonable valuations. We have identified many stocks using this approach, and invested our own money. We believe this course can help you to begin your journey as a value investor. At the end of this module, you will be able to learn: who is Warren Buffett? How to pick stocks like Warren Buffett? And what is your circle of competence? Warren Buffett is one of the most successful investors of our time. How this financial wizard got there is a fascinating story. Warren Buffett was a young boy delivering newspapers in Omaha, Nebraska. He got into the investing game very early. At age 11, young Warren bought 3 shares of City's Service at $38 per share, and then sold it around $40. In between, it went down to $27. And after he sold it at $40, it jumped to $200. He realized his mistake. This experience taught him a very important and basic lesson of investing: patience is key. In 1956, Buffett started a partnership with 7 people called Buffett Associates. The entire partnership had $105,100 in capital. Buffett's contribution was $100. Over the next 9 years, this partnership had grown to $26 million, a stunning 24,000% increase. In 1965, Buffett took over a failing textile company, Berkshire Hathaway. Buffett transformed it into a massive holding company. He started buying companies through Berkshire Hathaway. Buffett first bought 2 Nebraska-based insurance companies. Gradually he bought stakes in companies like Coca-Cola, American Express, Gillette, and Washington Post. For over 60 years, Buffett has been able to tap dance to work, doing what he loves doing. By the time Buffett was 15, he already had a net worth of about $6,000. He made his $1 million mark around 30 years old, and $1 billion at 56 years old. The investing legend has amassed a fortune of $85 billion, and become the 3rd richest man in the world. Buffett says, he just feels very, very lucky. In 2006, Warren Buffett had pledged to donate 99% of his wealth to charities. Buffett has given away $37 billion of his wealth, with most of it going to the Bill and Melinda Gates Foundation since 2006. The book value of Berkshire Hathaway compounded at an annual rate of 20.3% since 1965. Today, Berkshire Hathaway is the 6th largest company in the world, with a market cap of around $500 billion, and holding around $145 billion in cash. What is the secret behind his success? How does he pick the right investments? Warren Buffett and Charlie Munger invented an investment framework called the 4 filters. The 4 filters can help you to narrow down your investment ideas, eliminate low-quality ideas, and improve the probability of your investment success. The 4 filters invention by Warren Buffett and Charlie Munger. Warren and Charlie look for companies that have a simple and understandable business, that have favorable long-term prospects, run by able and trustworthy management, and available at an attractive price. A long-term investor must apply these filters top to bottom. When we applied the first 3 filters top to bottom, we found around 100 companies that passed the test out of 5,000 plus companies listed in the market. Most companies fail in this test. Buffett advises investors to evaluate stocks the way they would evaluate a farm, by looking at what the business will produce over time relative to the purchase price. Filter number 1, simple and understandable business. Warren and Charlie look for simple businesses. If Warren cannot understand a company's business, and he won't attempt to value it. Warren has avoided technology stocks in the past, and has continued to buy and hold banks and consumer stocks. You ask questions such as, is the business simple and understandable? Only evaluate businesses that you understand. Buffett's ground rules for success. Stick with businesses that you truly understand. Avoid businesses that are complex, or subject to constant change. Research thoroughly before you buy. Practice buy and hold. Follow your advice. Filter number 2, favorable long-term prospects. Warren wants to own simple and stable businesses that have a sustainable competitive advantage. Sustainable competitive advantage comes from things that make a company difficult to copy. It is a barrier to entry, for example, a brand, patent, low-cost producer, and network effect. According to Buffett, it is too hard to predict the long-term prospects of companies that operate in fast-changing industries. Buffett once said, he has 3 boxes on his desk, in, out, and too hard. You ask questions such as, does the business have favorable long-term prospects? Buffett's ground rules for success. Look for companies that have been producing the same product or service for several years. Find companies with strong moats such as brands, patents, low-cost operation and network effect. Determine what the company will look like in 10 years. Filter number 3, able and trustworthy management. Management is the most important filter in the evaluation process. According to Buffett, you cannot make a good deal with a bad person. You can learn a lot about management by reading what they have accomplished, and what their competitors have accomplished, and also how they have allocated capital. You ask questions such as, how management has allocated capital over time? How well management treat minority shareholders? Buffett's ground rules for success. Quality of management is extremely important. Look at what management has accomplished in its industry. Invest your money with people you can trust. Buffett looks for 3 things in a person: intelligence, energy, and integrity. If they don't have the last one, he doesn't even bother with the other 2. Filter number 4, attractive price. According to Benjamin Graham, the margin of safety is the difference between estimated fair value and buy price. Buffett once said, the 3 most important words in investing are margin of safety. Margin of safety limits the size of losses, in case there are errors in your fair value estimate, or assumption. Buffett believes the margin of safety principle to be the cornerstone of investment success. Buffett prefers to buy stocks at least 30% below its estimated fair value. For example, if a stock's estimated fair value is $100 per share, then he would prefer to buy at $70. Buffett's ground rules for success. Margin of safety limits the size of losses. Don't buy stocks at the peak. Buy quality stocks at a reasonable price, at least 30 to 50% discount. Buy good quality stocks during market crash. Buy only when you like the price. Patience is key. Warren and Charlie look for companies that they can easily understand, with favorable long-term prospects, operated by able and trustworthy management, and available at an attractive price. The Circle of Competence is a mental model developed by Warren Buffett and Charlie Munger, which will help you to make smarter investment decisions, and fewer mistakes. What is Circle of Competence? Circle of competence is the difference between what you think you know and what you actually know. According to Buffett, you don't have to be right about thousands and thousands of companies. You only have to be right about few. You don't have to understand all kind of businesses. As a long-term investor, you only have to be right about 6 to 10 companies. Ted Williams wrote a book called The Science of Hitting. He got the strike zone divided into 77 squares. If he only swings at pitches in his sweet spot, his batting average would be 400. But if he had to swing at the lower corner, his average would be 230. The most important thing in hitting is waiting for the right pitch. According to Buffett, in investing there is no called strikes. People can throw many ideas, you name it. You don't have to swing. You can wait there, and look at thousands of companies, day after day. Only when you see something you understand, and like the price, then you may swing. If you miss, that is okay. Buffett once said, one of the things they try very hard to do at Berkshire, is to stay within what he calls their circle of competence. Bill Gates is a good friend of Warren, and Warren thinks Bill may be the smartest guy he ever met. But he doesn't know what those little things do. So, he didn't invest in Microsoft. Warren advises, stick to what you know. If Buffett cannot understand a company's business, he won't attempt to value it, as it lies beyond his circle of competence. This is why he avoided technology stocks. He continued to buy and hold what he knew. For example, he was interested in buying a large stake in Apple, Bank of America, Coca-Cola, and American Express, because he understood the company's products and its business model. Buffett is not bothered when he misses out on big returns in businesses he doesn't understand. He strongly feels that investors can do very well by simply avoiding big mistakes. According to him, what counts most for investors is not what they know, but how realistically they can define what they don't know. Understanding one's circle of competence is a great way for beginners to start investing. It narrows down the list of available options into something more manageable. This investment strategy makes it easier for the new investors to understand the company's competitive strengths and weaknesses. They are in a better position to understand its markets and products. Buffett's ground rules for investment success. Simply avoid big mistakes. Avoid companies that you don't understand. Avoid low-quality companies. Don't buy stocks at the peak. Define what you know. Define what you don't know. You don't need a degree in finance or economics to develop a strong circle of competence. To find your circle of competence, think about your education, interests, and work experience. For example, an IT consultant can understand how IT companies make money, while doctors can understand healthcare. You may also look for companies whose products are used in everyday life: soap, toothpaste, razors, diapers, etc. These businesses are simple to understand. Once you have determined your circle of competence, you can identify a list of companies in that area. Then we can go to the next step. One of the keys to Warren Buffett's financial success is his belief in the circle of competence. Therefore, finding your circle of competence is the first and the most important step towards smart investing. Once you have accomplished this, stay within your circle of competence. Warren likes to say that there are no called strikes in investing. Strikes occur only when you swing and miss. Know your area of expertise. Identify companies in that area. Identify companies you should avoid. What is your educational qualification? What is your work experience? Explain in 2 to 3 lines. What is your area of interest? For example, watching movies, reading, shopping, driving, etc. What is your circle of competence? Explain why. Please note that your assignment will be based on your answers. Send your answers to myvaluepicks@gmail.com. Thank you for your interest in the Value Investing online course by myvaluepicks.com. If you liked the video, please hit the like button. If you want to see more videos, hit the subscribe button, and if you have something to say, please leave a comment. Please read the following terms and conditions carefully and completely.